Many of you enjoy watching my two undervalued stocks to consider videos. I do them every single month talking about two stocks that I research and I believe they are undervalued. Now, I normally don't disclose if I own them. Some of them I do. Some of them I don't, but I just believe they're pretty undervalued and I share them with you guys on the channel. But in this video, I decided to do something very, very different. This is December, it's the last month of the year, a holiday month. So I decided to talk about two stocks that I believe are undervalued that I actually own. I have them in my own portfolio. I'm going to tell you my cost basis on them. I'm going to tell you everything about them. I think a lot of you are going to enjoy this kind of video, and normally they don't get a lot of views. I don't know why. Is it not as much as they used to before? So all I ask, if you enjoy it, please press the like button and maybe decide to leave a nice comment or a bad comment or a mean comment or whatever you say. Just let me know. Let me know in the comment below. I don't mind. I read and I reply to all the comments. Most of you guys know that. And I'm going to start by talking a little bit about my strategy very, very quickly. And then I'm going to get into the two stocks. Now, one of them, most of you are familiar with the stock, but I never disclosed that I own it. But the second one is a stock that I've never analyzed on YouTube before. So it's going to be very interesting to see what you guys think about these two stocks. Now, in terms of my strategy, I try to implement the barbell strategy in my portfolio, meaning I put most of my money in large investments that are normally safe, small, mid to large cap kind of stocks that they have lower risk but lower returns. But I try to aim for 15% every single year or a double every 5 years in my videos and in my own portfolio whenever I'm looking at a large investment that's normally safe. And both of those stocks can return up to 15% every single year. Now, some of them return much more than 15%, but I try to aim at 15% because the S&P returns on average around 8 or 9%. So if I'm putting in all the work, I'm picking stocks, dealing with all these kind of things and researching them, I want to at least get a little bit more than the S&P. So around 14 to 15%, this is very good for me if I can get it with safe investments that are pretty large and with low risk. Now, the other part of my portfolio, and this is the stocks that I just cannot talk about on YouTube because they're pretty illiquid, pretty small. I mean, the videos can influence them a lot. I talk about them in my own group if you're interested in joining. But the small investments are pretty much small cap stocks, micro cap stocks. They are high risk, big payoffs. They are high risk because they're small. I don't invest in unprofitable companies. I mean, I have one that's about to turn profitable, but all the other ones, even the small ones, the micro cap ones, are profitable. I talked about one on YouTube. The name was MAMA, Mama Man Series. I'm up over 150% on this investment. I did a video on it over here. You can check it out. And I said how I selected it, and I shared my micro cap strategy. I shared a lot of things on YouTube, but most people, they don't get excited about them. They get excited about the market crash videos and all these other things, which is pretty interesting. But this is mainly my strategy. And in this video, I'm going to focus on the two large cap kind of safe investment stocks. And I really hope you enjoy this video. Now, the first stock that I haven't talked about in a while, but most of you are familiar with it. I think you could guess that I most likely own the stock, but I've never disclosed it. This is going to be the first time I disclose it on YouTube. And this is BJ's Wholesale Club. This is a kind of a business model like Costco, kind of a wholesale club, kind of business. Now, the interesting thing is most retail investors, they love Costco because it's the best ever and they love the brand and they have a Costco membership and all these kind of things. And I get it. And Costco pretty much outperformed every single retailer. Costco outperformed Walmart. Costco outperformed Target. Costco outperformed every single retailer except BJ's Wholesale Club. BJ's Wholesale Club is one of the best performing retailers over the last 5 years, up 180%. Even after the last drawdown, it's still up 180%. Costco returned 156%, while something like Walmart only returned 60%. Target, I think it's in the negative, and all the other ones pretty much suck. But the best performing two were BJ's Wholesale Club and Costco. Now, the interesting part about it is, and I talked about it, is that Costco is trading around 37 times earnings, and BJ's, which was also one of the best performers, is still trading at 16 times earnings. And this is the main opportunities that I see in the video. But in terms of BJ's, it has been flat for around 2 years. Costco has also been flat for 2 years. Target has been flat for years, I believe. I mean, I haven't looked at the chart recently, but both Costco and BJ's have been flat for pretty much 1.5 to 2 years. It has not been a good period for retailers. It was tough comp sales. you have a lot of theft. BJ's does not experience as much theft as something like Dollar General. I mean, the stores are pretty safe. I went to a lot of them many times. But BJ's is not a small company that just has like 5 or 6 stores. They have over 239 clubs in over 20 states and over 7 million members that have this subscription, the annual membership, over 7 million members. So this is not some kind of company that you've never heard of. Maybe you had never heard of it if you live in California, because they're not in California yet. They are mainly, a little bit more on the East Coast and in these kind of regions. And they have been expanding in new markets and they've been finding success. And many people on Twitter, they told me, yes, whenever Costco opens near BJ's, it's going to bankrupt them. Well, BJ's has been pretty much active since, I believe, 1972 or 1974. It's been a while. And BJ's is still here and Costco is still here. And there's just so many Costco's Costco can open, and BJ's is filling in the void between Costco's and different places. There's a lot of places where there's a Costco, there's a BJ's. And a lot of people are sick of the traffic at Costco. Maybe they are smaller families, but there's only 2 people. Maybe they don't want to buy 4 or 5 ketchups. They don't want to buy all these huge bulk items. BJ's has smaller bulk items that a lot of families love, and a lot of people have been going there. And BJ's stock has been performing well. The MFI, which is membership fee income, this is one of the most important metrics in terms of those wholesale club. Membership fee income has been pretty much making new highs pretty much every single year. And this is despite having no membership increase since 2017. So MFI has been increasing without membership increase, which the last one was in 2017. They are due for a membership increase, but I believe they're not going to increase it before Costco does. This is what BJ's normally do, which is pretty interesting. And the membership is still cheaper than Costco. So it's pretty interesting stuff with this company. The last earnings report wasn't the best at all, I have to admit. They expect comparable sales, which is one of the most important metrics with retailers, comparable sales. They expected from a 2% decrease to a 1% increase on a comp kind of basis. Now, I'm not satisfied with that. It's not good at all. But it has been a tough period in general. I mean, they experienced peak performance in 2021 and 2022. 2023, 2024 has been a little bit more challenging than it is. But the way I look at what BJ's is doing, they are opening new stores in new markets, in new states. They're finding success. They're doing everything that you want a company to do over the long term, reducing the balance sheet, buying back some stock, shares outstanding have been coming down, investing for growth in different metrics. They're trying to increase and better their stores much, much more. And we're seeing some of the results already. And I believe we're going to see something better in the future. EPS is unchanged, pretty much flat for 2024. So it's not the best outlook you can have, but this would give the company an easier time to beat. So I'm not really, worried about that too much, because I believe in the long-term potential of the company, and I believe the company is doing the right things for the long term by opening 10 new stores every single year and investing in new markets. Now, I have done a lot of valuations on something like BJ's, and this is not my main thesis, but I always like to compare these two companies, is that BJ's is trading at 16 times. Costco is trading at 38 times earnings. Now, BJ's has higher margins than Costco, higher gross margins, higher free cash flow margins, I believe also higher net income margins. But the only thing that Costco has better than BJ's, they have higher same-store sales growth, pretty much double BJ's. And this warrants a higher valuation, but it does not warrant 38 times earnings versus only 16 times. This is what I believe was BJ's. And the company and the market, started to realize the value of BJ's. It went up. It was trading around 20 times earnings. I believe 20 times earnings is fair for this company. But then every time they report something crazy or the market changes their minds, the stock goes back to 16 times. And if you follow this company, you most likely know that the stock does not correlate with the S&P at all. Whenever the S&P goes down, BJ's could go up. BJ's was pretty much performing much better than the S&P in 2022, unlike Costco. I'm not sure why, but it really doesn't correlate very closely with the S&P. The stock can go up while the S&P goes down 30%, or it can stay flat while the S&P goes up 30%. So it's very hard to kind of measure the performance of the stock because the S&P is going up and down. You have to look at earnings, and earnings haven't been bad at all, and they've been investing in the right things over the long term. Now, in terms of the potential return for BJ's, I have done analysis and valuations models before, but the company company's own guidance, they expect high single digits to low double digits EPS growth. I would see around 11 to 12% EPS growth, and I see a multiple expansion. I think BJ's should not be trading lower than something like 20 times earnings, and it used to trade at 20 times earnings, then the market gets pessimistic, it goes to 16 times, and then after a while, without any earnings or anything, it goes back to 18 or 20 times. It happens so many times over and over again. A lot of you have been, maybe own it or maybe, monitor the stock. This is how it's been happening. So with a multiple expansion and around 10 to 12% EPS growth, I would see something around 14 to 15% every single year over the long term with something like BJ's. BJ's is not going to make people rich or make you a millionaire or anything crazy if you put a small amount of money. But this is a safe investment that is low risk, that's going to do well in recessions, in inflation, in the war, and something crazy happens, the dollar, interest rates higher, interest rates lower, people need to eat, they need groceries, and they're going to go to BJ's, they're going to go to Costco. So this is the kind of business models I like. I like business models that are not cyclical, and they can do well no matter what. And I believe BJ's is doing all the right things, and the market is ultimately going to realize it in the future. So I'm being patient with this one. I mean, my cost basis is around $63 per share, and I've been buying into the stock a little bit lately, a little bit more, and it's already a large position in my portfolio, so I might not be adding a little bit more in the future unless it goes below $60 or $58. Then it's going to be too cheap to ignore, and I'm not sure if we're going there. But this is the first stock that I have, and I believe in it in the very long term. The second stock that I've never talked about before, and a lot of you are familiar with the name, and it's pretty hated actually. And this is a name called AutoZone, AZO. I do own AutoZone. My cost basis is in the low 2300s. I recently bought it. I'm not up a lot on the stock. I tried to pick two stocks that are close to my cost basis, so you guys don't tell me you only share stocks that you're up on. I have stocks that I'm flat on. BJ's and AutoZone are, one of those stocks. And AutoZone is now sitting at $2,600 per share. This is a very hated stock. And people keep saying, yeah, this is a bubble and it's going to crash and it can't keep going on forever. Yet the stock keeps going up. It keeps making new highs. And it's pretty amazing. And most of you are familiar with AutoZone. They sell auto parts in the United States to many different cars and many other things. And you could buy a lot of things from AutoZone. So a lot of you know the place. It's kind of like O'Reilly's and Advanced Auto Parts, but a much better business model. And AutoZone, they call it the cannibal. I think Charlie Munger calls the buyback kind of stocks cannibals. And the company grew over 9,055% in EPS from 1997 to 2022, while they bought back 84% of the shares outstanding. The stock buys back like 4 or 5% of the market cap pretty much every single year. It's been pretty stellar with something like AutoZone, and they keep buying back stock. Now, there's a lot of headwinds, but there's a lot of tailwinds with something like AutoZone. A lot of risks, but a lot of rewards. Now, one of the things that's going for them is higher car prices, because if car prices are higher, people are going to keep their car for longer, and if they keep their car for longer, it's likely going to have to be maintained more often. It's going to require more parts, and this is where AutoZone benefits. AutoZone benefits not only from people going to the stores and buying, but they have their commercial business, and the commercial business is benefiting for dealerships. They deliver parts and many other things. So this has been a pretty good kind of tailwind for something like AutoZone, because people are keeping their cars for longer, something like 12 or 13 years, and this is benefiting AutoZone in a major way. Now, something else that a lot of you are going to tell me is, what about EVs? Because if we have more EVs in the future, EVs don't have as many parts as ICE vehicles, and therefore business model like AutoZone is not going to work in only 6. Well, this is actually not true, because even after you have the EVs, yes, they're going to have less and less parts. I do agree, but these parts are going to be more expensive, and AutoZone is likely going to carry those parts. So AutoZone is not going to go to zero or anything crazy. But something else that a lot of people miss with AutoZone is that they don't only have stores in the United States. They have stores in Mexico, around 740 stores, and they have over 100 stores in Brazil, and they are expanding in these markets. They're finding huge success. And Brazil and Mexico, they don't have as a high or as fast of an EV penetration rate as the United States. So it's going to take at least 10 to 15 years, in my opinion, for something like AutoZone to be affected from EVs. And from now then, maybe AutoZone will be sitting at $5,000 or $6,000 per share. I mean, we don't really know where it could go, but this is something pretty interesting. I just love the business model so much, and I'm going to tell you a little bit why later on in the future. But a big risk with something like AutoZone, yes, they are buying back stock a lot, but they're using some debt to buy back stock. And this is something that I really don't like with something like AutoZone. What I am worried about a little bit in the future is the long-term debt. And it's over $7.3 billion. This is a lot of debt. And this company like AutoZone should have a lot of debt because of the business model is pretty resilient. Something like AT&T has a lot of debt because the business model is resilient. So such companies should operate with a lot of debt. But AutoZone's debt is getting a little bit excessive, and they keep using the free cash flow to buy back stock, to make EPS grow a little bit better than it should, around 13 or 14% annual. And this is amazing. And a lot of people said that they can't keep doing it forever. They can't keep borrowing money and buying back stock and doing this forever. But AutoZone has been doing it for pretty much 40 or 50 years, and it's still doing it. But I would prefer if they pause the buybacks a little bit and start, paying down some of the debt. Because if this continues over the next 10 or 15 years, and it's going to be concerning in terms of the debt level of AutoZone that I could potentially have. So this is a big risk with AutoZone, is maybe the debt, although the free cash flow is resilient, the company is not going bankrupt. And the second risk could be something with the EVs. Now, this is a pretty interesting company, and it's only trading around 18 times earnings right now. Now, I would prefer to buy AutoZone around 16 times earnings. When I bought it, it was below 16 times earnings, around some 15.8 to 16 times earnings. This would be something pretty amazing with AutoZone. They have high returns on capital, over 38% return on capital. They are still growing same-store sales around 6 to 7% for a mature company. Now trading around 18 times. In terms of EPS has been growing 12% every single year, and it's expected to grow 12 to 13% over the coming year for something like AutoZone. So I'm getting a pretty resilient business model at 12 to 13% EPS growth, high return on capital, buying back stock. The management is pretty amazing, very amazing track record. And one of the most important things is the business being bulletproof, kind of a recession-proof kind of business model. This is what I really like. Now, I have to admit, AutoZone is a little bit expensive at 18 times earnings. So I'm personally not buying it at this second, but if it ever goes back below 16 or 15 times earnings, this would be an amazing, amazing return. But if you buy AutoZone today, I would not expect you to get more than 12 or 13%, which is EPS growth every single year. I would see 12 to 13% return. But if you do buy it around 15 times earnings, you get the potential for a multiple expansion back to 18 times where it's trading right now. And then you could get around 15 to 16% every single year. Again, these stocks might not be the most exciting stocks. They might not be something like Palantir or the best stocks in the world. But these are two stocks that I own within my large investment, safe, low risks kind of stocks. It was not financial advice. Don't copy me on these stocks because maybe I change my mind tomorrow and I sell it. I don't have to update you here on YouTube. If you're interested in more updates, you could consider joining my own group if you'd like to maybe find out my small investments, high risk, big payoff kind of stuff. So thank you for watching the video. I really hope you enjoyed it. So if you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.